So, there is news that there is going to be a 40-year fixed rate mortgage launched into the marketplace fairly shortly. That's right, a 40-year fixed rate mortgage. What do you need to know? What do the numbers tell us? What's the detail? That's what we're going to be going through in this video. All right, so let's address the elephant in the room. If a 40-year fixed rate mortgage is a positive thing in terms of your financial planning, so you can budget, you can have your mortgage payments actually fixed for a very long time to enable you to plan financially, why haven't these banks launched a 40-year fixed rate mortgage 10, 15 years ago? Why do it now? Well, let's backtrack a little bit here. So there's a lot of news at the moment, and you've been following the channel, you know that I've spoken about it. Inflation. There is a big threat around inflation right now and interest rates increasing as a result of that. First and foremost, let's have a look at the historic interest rates when it comes to mortgages. In the 1970s, mortgage rates were absolutely ridiculous. More recently, we have seen historically low interest rates. And with that is essentially a problem. It's been very, very cheap for you to borrow money for property purchases, be that a residential or maybe an investment property, a buy-to-let, so on and so forth. And the fear around inflation being forecasted to be at 5% by the time we hit April 2022. Providers, well, one provider in particular is now looking at an opportunity to launch something that is going to be brand new. Now, the concept of a 40-year mortgage is actually not alien. Americans have been doing this for years. Americans take out fixed rate mortgages for 30 odd years, 35 years, 40 years. It's just something that we haven't tended to do here in the UK. What we traditionally do, and you'll be aware of this, is you will take out a fixed rate deal for 2 years, for 5 years, maybe a little bit longer, and then you would essentially rebroker or remortgage your mortgage at the end of that fixed rate term. And the idea is at that point, maybe you might have seen the interest rates fall. Now that works nicely when rates are high. If rates are at say 10% or 5%, even 15% like they were back in the 70s, then that actually makes logical sense, because if you fix yourself in for 2 years and the interest rates have fallen by 2 or 3% in that period of time, when you come to remortgage, then obviously you can access a cheaper rate. With the landscape right now, with interest rates being historically low, the mortgage rates can't go any lower than this. And so the 40-year fixed rate mortgage being introduced into the market is designed to basically combat the fear that interest rates are going to start to increase. And therefore, millions of people here in the UK who are homeowners will be able to lock in into a low price, a low rate to fix their mortgage repayments. Now, that may sound lovely, and there are some advantages here, but there are also some questions that maybe need to be asked. So let's look at the advantages. The advantages are you'll be able to plan better from a financial point of view because you know what your mortgage is going to be for 40 odd years or up to 40 years, for example, right? You won't have to remortgage every 2 to 5 years, which means that you're not then paying new fees for the privilege of remortgaging. So you're also going to save a little bit of money there. But this is where the questions essentially come in. What are the rates that are going to be offered for this ultra long mortgage? So are they going to be offered at 3%, 4%, 5%? What are the rates going to be? How much is that going to cost you over the long term? And more importantly, if rates do increase, but then fall during that 40-year term, are you going to be penalized for moving your mortgage or breaking the terms of that 40-year fixed? Those are all questions. I don't have answers to all of those, but based on what I have been able to find on the internet so far, I'm going to walk you through what the proposed rates are at this point in time, and maybe just take you through some of the numbers so you can kind of get an idea of what that would translate to in terms of pounds and pence. If you're in a position where actually you're listening to this and you're thinking, sign me up, Pete, I'll happily sign up for a 40-year fixed rate mortgage. So this is the Financial Times. And I'm just going to go up here very, very quickly because this is the lender that's looking to introduce these into the market is Kensington Mortgages. Now, I will leave a link to this article right here so you can go and read it at your own time. But I do want to pay attention specifically to some of the rates that they're actually suggesting will be available, which is in this column right here. So for the longest dated mortgages of 35 and 40 years, rates will start at 3.16% and 3.34% respectively, at a 60% loan to value. This is really important detail, guys. So it's saying that the rates are going to start there. Doesn't mean that that's the rate that you're going to get. Now, personally, I think 3.16, 3.34 is actually a relatively good rate. Loan to value, though, may be an issue for many people. So if you don't have equity in your property, you might be a first time buyer. This may actually end up being a little bit more expensive for you, because if you're a first time buyer, you're likely going to have a higher loan to value, maybe an 80 to 90% loan to value. We don't know what the rates are going to be for those, but you can guarantee right now that you're probably going to be looking in the region of about 4.5%, maybe 5% if you're a first time buyer. So this is going to benefit people who have a low loan to value. If you don't know what a loan to value is, it's essentially what the value of the house is versus the mortgage that you have on the house. So let's just say, for example, and this is the number that I'm going to be using in the rest of this video, you have a £200,000 house and your loan to value is 60%. That means you only owe £120,000 on the property. It also says here, rates at the short end of the mortgage terms will be lower, starting at 2.83% for a 15-year product, and at the same loan to value, so that's 60% loan to value. And for 25 and 30-year terms, rates will be available from 2.85% and 2.9% respectively. So let's actually have a look at what those numbers look like from a practical point of view. I've done this using a calculator online, which I will also link to as well. So the average, I think, property in the UK is around about £200,000. So again, using this example of 60% loan to value, and let's just say you are going for a 35-year term. So your rate at that point is going to start at 3.16%. Over for 35 years with a mortgage of £120,000, that will mean that your monthly payment will be £473 per month. Now, you may be looking at and thinking, actually, that's great because it's less than £500, which it is. It will allow you to budget and plan, forward think your finances. So you know you're not going to have to change that amount, and that amount is not going to change for 35 years. That will give you a lot of peace of mind. The total cost of that mortgage, though, when you factor in all of the interest, is going to be £190,260 altogether. So you're paying quite a bit in interest, around about £70,000 worth of interest, really, over that 35 years, I should say. Now, if you go for a 40-year term, and that's £120,000 again, we're using that as the mortgage amount, at a rate of 3.34% over 40 years, your payments will be £453 per month. So for taking out an extra 5 years on a fixed rate term, so 40 years as opposed to 35 years, you're going to save yourself in monthly payments £20 per month. Now, you can do the multiples on that and see how much difference that's going to make in terms of your monthly payments versus the £473 a month on a 35-year term. But the cost of the mortgage is significantly more. Number one, the interest rate is a lot higher, even though your monthly payments are lower. And the combination of that time difference and the higher interest rate will mean that the total cost of that mortgage will be £217,440. That's a £27,000 difference, essentially. And that's why, if you're going to be looking at these kind of mortgages, it's really important for you to sit down and actually do the numbers, and maybe speak to a qualified mortgage advisor who can walk you through this. Now, I no longer advise on mortgages. It's not what I do right now. I obviously create content online here on YouTube to help people. But, these kind of conversations and these decisions need to be taken with professional help. So please go and sort a really good mortgage advisor who can actually advise you and help you map maybe a little bit of your finances. Again, I have to stress, these rates are starting at. So it says here the rates will start at. So if you go and apply for one of these, depending on your loan to value, these aren't the rates that you're going to see. So I think overall, this will definitely help people plan ahead in terms of knowing that your mortgage expenditure, which is often your biggest monthly expenditure, will be fixed for a very, very long time. But you do need to take into consideration the fact that because you're fixing in for a longer period of time, does that mean that you're going to be paying more? It's hard to do a comparison if you're going into a 2 or a 5 year fixed rate and then rebrokering each time. It's hard to make that direct comparison. an advantage is you're not going to be paying remortgaging fees. That's going to negate all of that. So arguably, this could be a better saving vehicle when it comes to being able to plan for your mortgage long term more than anything else. But the big question I have is, are there going to be penalties? I read some things this morning saying that there wouldn't be any penalties. If that is the case, I'll be very, very surprised, because that's how these providers are going to be able to lock you in to their product and to that contract, because their profitability is dependent on you being in that contract and paying that rate. So I'll be very, very surprised if there are no penalty fees. But if there aren't any penalty fees, then all of a sudden this becomes very, 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 very attractive indeed. But I don't know. Did you find this useful? Would you sign up to a 40-year fixed rate mortgage? Would you sign up to a 20 or 35-year fixed rate mortgage? Let me know your thoughts. Hope that was helpful.